ExamPrep.School. Virginia Life and Annuities Health Insurance Exam. Exam code SERIES 11-1. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Annuities, dental insurance, disability income and related insurance, federal tax, health insurance, federal tax, life and annuities, general insurance, group health insurance basics, individual health policy, general provisions, insurance for seniors and special needs, life insurance basics, life insurance policies, medical plans, policy provisions, options and riders, qualified plans, Virginia health of state laws, Virginia insurance regulation and licensing, Virginia life and annuities, state laws, Virginia Medicare supplement and long-term care, standards and marketing rules. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. In insurance, risk pooling primarily relies on which statistical principle to decrease variability of losses across a large number of exposures? A. Law of diminishing returns. B. Bayes' theorem. C. Law of large numbers. D. Expected utility principle. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. The law of large numbers describes how pooling a large number of similar, independent exposures reduces variability in loss experience, which is the basis for risk pooling in insurance. Reason A is not correct. The law of diminishing returns concerns marginal benefit reduction, not variability reduction in pooled risks. Reason B is not correct. Bayes' theorem is about conditional probabilities, not the aggregation of independent risks to reduce variance. Reason D is not correct. The expected utility principle deals with decision-making under risk, not statistical reduction of loss variability. Question 2. The rule of contra proferentem in insurance is most relevant to which characteristic of a contract of adhesion? A. Policy terms drafted entirely by the insurer and offered on a take-it-or-leave-it basis with ambiguities construed against the drafting party. B. Terms negotiated bilaterally by insurer and insured before issuance. C. Mutual modification of policy provisions by both parties post-issuance. D. Requirement that the insured must share in loss retention through deductibles. The correct answer is A. A contract of adhesion is drafted by the insurer without negotiation. The rule of contra proferentem resolves any ambiguity against the drafting party, protecting the insured in case of unclear language. Reason B is not correct. Negotiated bilateral terms describe a negotiated contract, not a non-negotiable adhesion contract. Reason C is not correct. Mutual post-issuance modification would require ongoing negotiation, which contradicts the take-it-or-leave-it nature. Reason D is not correct. Loss retention through deductibles is a policy feature, not a defining attribute of an adhesion contract. Question 3. Although an insurer's agency contract is silent on binder authority, the insurer never objected when its appointed agent routinely issued temporary coverage binders and collected initial premiums. When a claim arose during the binder period, the insurer denied coverage, arguing the agent lacked express binder authority. Which type of authority most likely supports the insured's position that coverage was valid? A. Express authority. B. Apparent authority. C. Implied authority. D. Ratification. The correct answer is C. The correct answer is implied authority, which arises when an agent must perform tasks not explicitly stated in the contract, but necessary for carrying out the insurer's business, because the insurer's silence and consistent acquiescence to the agent's issuance of binders and premium collection created a course of dealing. The agent had the unstated power to bind coverage temporarily. Reason A is not correct. The contract did authorize certain functions, but it did not explicitly grant binder power, so express authority does not apply. Reason B is not correct. Apparent authority is based on third-party perceptions of an agent's power, whereas the issue here is the agent's unstated but necessary ability to issue binders under standard practice. Reason D is not correct. Ratification requires the insurer to approve the agent's actions after the fact, but there is no evidence the insurer ever ratified the temporary binders. Question 4. Which type of insurer is characterized by policyholders reciprocally insuring one another through an attorney-in-fact who manages the exchange? A. Mutual insurer. B. Stock insurer. C. Risk retention group. D. Reciprocal insurer. The correct answer is D. Reciprocal insurers are organized so that subscribers exchange policies among themselves and appoint an attorney-in-fact to administer the insurer's operations. Reason A is not correct. Mutual insurers are owned by policyholders but do not operate through an attorney-in-fact model. Reason B is not correct. Stock insurers are owned by shareholders and do not involve subscriber-managed exchanges. Reason C is not correct. Risk retention groups are liability insurers for members of a common industry or group, not reciprocal exchanges. Question 5. A surplus lines producer is arranging coverage for a business risk that admitted carriers have declined. The producer has received written declinations from 2 authorized insurers. Before placing the coverage with a non-admitted insurer, the producer must obtain written declinations from how many authorized insurers? A. 1. B. 2. C. 4. D. 3. The correct answer is D. The correct answer is 3 because regulations require written declinations from 3 authorized insurers before coverage may be placed with a non-admitted surplus lines insurer. Reason A is not correct. One declination is insufficient because the law mandates multiple refusals to ensure admitted market options have been exhausted. Reason B is not correct. 2 declinations fall short of the requirement. A third refusal is needed to satisfy the exhaustion requirement. Reason C is not correct. 4 declinations exceed the statutory minimum and are not required before placing the coverage with a non-admitted insurer. Question 6. Under state insurance regulations, the process by which an insurer files a notice with the state insurance department designating a licensed producer to sell its products on the insurer's behalf is known as what? A. Authorization. B. Appointment. C. Certification. D. Accreditation. The correct answer is B. The term refers to the formal filing by an insurer to name a licensed producer as its representative, which is known as an appointment. Reason A is not correct. Authorization refers to an insurer's internal approval for a producer, not the state filing process. Reason C is not correct. Certification relates to a producer's credentials or licensure status, not the insurer's designation process. Reason D is not correct. Accreditation involves granting recognition or approval status and is not the term used in state appointment filings. Question 7. According to best interest obligations for life insurance and annuity recommendations, what is the initial step a producer must complete before making a recommendation? A. Compare available product alternatives. B. Gather the customer's financial situation, needs, and objectives. C. Document the basis for the recommended product. D. Provide the customer a written recommendation summary. The correct answer is B. The best interest standard requires first obtaining the customer's financial profile, needs, and objectives before any analysis or recommendation. Reason A is not correct. Comparing alternatives happens after customer information is collected. Reason C is not correct. Documenting the rationale occurs later, after analyzing options. Reason D is not correct. Providing a written summary follows the recommendation stage, not the initial information gathering. Question 8. Which of the following best encapsulates the doctrine of insurable interest as required for a life insurance contract's validity at inception? A. A tangible economic stake in the insured's continued life, or a measurable financial loss upon the insured's death. B. A purely sentimental relationship recognized by common law is sufficient to bind a contract. C. A future expectancy in estates or inheritance contingent solely upon the insured's death. D. A contractual assurance by an insurer to reimburse funeral expenses post-mortem. The correct answer is A. The correct answer is the one that defines insurable interest as a financial stake in the insured's survival or death, which is the legal requirement for a valid life insurance contract at inception. Reason B is not correct. Sentimental or emotional relationships alone do not satisfy the legal requirement for insurable interest. Reason C is not correct. A mere expectancy of inheritance is not an actual financial stake at policy inception. Reason D is not correct. Reimbursement of expenses is not the basis for establishing insurable interest, which depends on financial risk. Question 9. When determining an individual's human life value for life insurance purposes, which component is primary in the computation? A. The insured's projected future earnings, less assumed personal maintenance and tax obligations, discounted to present value. B. The sum of the insured's current assets minus liabilities at policy issue. C. The face amount required to equalize estate taxes and final expenses. D. The collective emotional well-being provided to survivors by the insured. The correct answer is A. The correct answer identifies that human life value is based on the present value of the insured's future earnings net of personal maintenance and taxes. Reason B is not correct. Net worth calculations of assets and liabilities are not used in the human life value method. Reason C is not correct. Estate tax needs and final expenses pertain to needs analysis, not human life value calculations. Reason D is not correct. Emotional or moral worth is not quantifiable in the human life value approach. Question 10. A privately held consulting firm relies heavily on its lead consultant, whose specialized expertise drives most client revenue. To protect against potential financial losses and preserve client relationships if the consultant were to die unexpectedly, the owners secure a key person life insurance policy on that individual. Which element of the firm's needs analysis does this policy most directly address? A. Compensation of future revenue shortfalls due to loss of expertise. B. Funding of personal estate equalization among heirs. C. Assurance of cross-training expenses for staff. D. Coverage of employee benefits liability. The correct answer is A. The key person policy is designed to offset the loss of revenue generation attributable to the individual's specialized expertise, directly protecting the firm's financial performance. Reason B is not correct. This addresses personal estate planning rather than the firm's need to maintain revenue continuity. Reason C is not correct. This covers training costs instead of compensating for lost revenue from the specialist's absence. Reason D is not correct. This pertains to benefit obligations and not to safeguarding revenue against loss of expertise. Question 11. Which document is required on a corporate-owned life insurance application for an executive, but is not required on an individual's personal life insurance application? A. Driver's license copy of the executive applicant. B. Corporate resolution authorizing the policy purchase. C. Personal net worth statement of the executive. D. Health questionnaire completed by the beneficiary. The correct answer is B. A corporate resolution is necessary to evidence board approval and establish insurable interest for a business-owned policy, and it is not required when an individual applies for personal coverage. Reason A is not correct. A driver's license copy is used for identity verification in both personal and corporate applications, so it isn't unique to business-owned policies. Reason C is not correct. A personal net worth statement is not a standard requirement for either corporate or individual life insurance applications. Reason D is not correct. A beneficiary's health questionnaire is irrelevant because only the insured's health information is needed on the application. Question 12. A corporation purchases a life insurance policy on its CFO and pays all premiums. The policy names the CFO's spouse as the irrevocable beneficiary. Which practice has the corporation violated? A. Structuring the policy as corporate-owned high-person insurance with the business as beneficiary. B. Funding all premiums for a key employee's policy directly through the business. C. Naming a personal beneficiary on a corporate-owned life insurance policy. D. Applying policy dividends to reduce future premium payments. The correct answer is C. Business-owned life insurance policies must name the business as beneficiary to preserve the company's insurable interest and intended benefits. Naming a personal beneficiary on a corporate-owned policy is prohibited. Reason A is not correct. This describes a permissible key person arrangement where the business is the beneficiary and retains insurable interest. Reason B is not correct. Paying premiums for a key employee's policy is allowed and does not conflict with business use rules. Reason D is not correct. Using policy dividends to offset premium payments is an accepted financing method and not a prohibited practice. Question 13. Under the NAIC model regulation, on life insurance policy replacements, which of the following is required concerning the notice regarding replacement? A. It must be furnished only when the replacement policy is issued by a different insurer. B. It must be signed by the applicant and the producer at the time the application is taken. C. It must accompany the policy summary at the time of policy delivery. D. It may be provided within 10 days after the applicant receives the new policy. The correct answer is B. The correct answer is the requirement that the notice regarding replacement be signed by both the applicant and the producer at the time the application is taken, as stipulated by the NAIC model regulation on replacements. Reason A is not correct. The notice is required for all replacements, not solely those involving a different insurer. Reason C is not correct. The notice must be provided at application, not delivered at policy delivery with the policy summary. Reason D is not correct. The notice cannot be delayed until after policy receipt. It must precede or coincide with the application. Question 14. After a life insurance policy is issued, an agent mails the policy by certified mail to the applicant's business address and leaves a voicemail instructing the applicant to pick it up at the post office. Several days later, the applicant claims never to have received the policy. Which action should the agent have taken at the time of delivery to ensure proper proof of delivery? A. Require the applicant to present government-issued photo identification. B. Obtain the applicant's signature on a delivery receipt. C. Have the applicant's coworker sign for the policy on behalf of the applicant. D. Provide a conditional receipt when the policy arrived at the post office. The correct answer is B. The correct answer is to obtain the applicant's signature on a delivery receipt, because it provides documented proof that the policy was received by the insured. Reason A is not correct. Requiring photo ID is not a statutory requirement for proving policy delivery. Reason C is not correct. Having a coworker sign does not establish that the insured personally received the policy. Reason D is not correct. A conditional receipt applies at the time of application, not at policy delivery. Question 15. When a term life insurance policy with a conversion privilege is converted to a permanent policy without evidence of insurability, The premium for the new policy is most commonly based on the insured's A. Original age at the time the term policy was first issued. B. Age nearest birthday at the end of the level premium period. C. Issue age specified on the new permanent policy's contract. D. Attained age of the insured at the time of conversion. The correct answer is D. This option is correct because when converting a term policy to a permanent policy under the conversion privilege, insurers calculate premiums using the insured's attained age at conversion rather than the original issue age. Reason A is not correct. Premiums are not based on the original issue age of the term policy once conversion occurs. Reason B is not correct. Conversion premiums use the insured's actual attained age, not the age at the end of the level period. Reason C is not correct. The new contract does not establish a separate issue age for premium calculation under the conversion privilege. Question 16. Jane holds a 20-year level term life insurance policy and plans to borrow against its cash value after 10 years to help pay for her child's college tuition. Which statement is correct about cash value under this policy? A. It begins accumulating after the first policy anniversary. B. It only accrues once the policy is converted to a permanent form. C. It becomes available if a return of premium rider is attached. D. It never accumulates because term policies lack a savings component. The correct answer is D. Term life insurance does not include a savings or investment feature, so it does not build cash value at any point during the term. Reason A is not correct. Term policies are pure protection contracts and do not begin cash accumulation after any anniversary. Reason B is not correct. Converting creates a new permanent policy that can accumulate value going forward, but does not retroactively create cash value under the term policy. Reason C is not correct. A return of premium rider refunds paid premiums at the end of the term, but does not create a cash value that can be borrowed against. Question 17. Alan owns a universal life policy with a level death benefit of $100,000. By policy year 5, his cash value has grown to $95,000 due to extra premium payments. But the death benefit remains unchanged. What is the most likely tax-related consequence under IRS corridor requirements? A. The insurer must impose a surrender charge to maintain corridor compliance. B. Future premiums will automatically adjust to reestablish the required corridor. C. It will become a modified endowment contract and lose tax-deferred status. D. The death benefit will automatically increase until the corridor is restored. The correct answer is C. When cash value approaches the level death benefit too closely, the policy fails the IRS corridor test and becomes a modified endowment contract, losing its favorable tax treatment. Reason A is not correct. Surrender charges relate to policy withdrawals or terminations, not corridor compliance. Reason B is not correct. Insurers do not adjust premiums automatically. Restoring the corridor requires the owner to increase the death benefit or reduce cash value. Reason D is not correct. Death benefits do not automatically increase. The owner must elect to raise them to satisfy IRS requirements. Question 18. Which statement best describes continuation rights under a limited pay whole life policy? A. The policy owner must surrender the cash value as a single lump sum at the end of the payment period. B. The insurer must convert the policy to term insurance at the original death benefit amount upon request. C. The policy remains fully in force without further premium payments until the insured's death. D. Coverage terminates immediately if no further premium payments are made after the payment period ends. The correct answer is C. Once the specified limited pay period is complete, the policy is fully paid up and no additional premiums are required, allowing the full death benefit coverage to continue for the life of the insured. Reason A is not correct. Surrendering for cash value is one non-forfeiture option, but it is not required to continue coverage under a paid-up policy. Reason B is not correct. Conversion rights to term policies are a separate feature and are not automatically provided at the end of a limited pay period. Reason D is not correct. A paid-up policy does not lapse for lack of further payments. It continues at full face amount once the payment period concludes. Question 19. A 45-year-old insured holding a 20-year level term policy within the conversion period has recently developed a chronic health condition and elects to convert to a whole life policy. Which of the following applies when exercising the conversion privilege? A. Evidence of insurability is not required when exercising the conversion privilege. B. Evidence of insurability is required to convert the term policy to whole life. C. Premium rates for the converted policy are determined using the insured's original issue age. D. The converted policy will lose its guaranteed cash value feature for the first 5 years. The correct answer is A. The conversion privilege allows a term policy to be exchanged for whole life without proof of insurability, and the new policy's premiums are based on attained age. Reason B is not correct. The conversion privilege specifically waives the requirement for proof of insurability, so evidence is not required. Reason C is not correct. Premiums for the new whole life policy are based on the insured's attained age at conversion, not the original issue age. Reason D is not correct. The converted policy retains all whole life guarantees, including a cash value accumulation. Question 20. An insured allows premiums on a limited pay whole life policy to lapse at the end of the grace period and makes no election of non-forfeiture options. Which non-forfeiture option will be applied by default? A. Use the cash value to purchase term insurance for the full face amount for a specified period. B. Convert the cash surrender value into paid-up additions to increase the death benefit. C. Receive the cash surrender value immediately in a lump sum payment. D. Obtain a reduced face amount whole life policy fully paid up. The correct answer is A. When no election is made, the cash surrender value automatically purchases extended term insurance equal to the original face amount for the duration determined by the cash value. Reason B is not correct. That describes paid-up additions, which is a rider benefit, not a non-forfeiture option. Reason C is not correct. Receiving a lump sum cash value is the cash surrender option, not the automatic default. Reason D is not correct. Reducing the face amount to a paid-up whole life policy describes the reduced paid-up option, not extended term. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.